A conflict has erupted in the Middle East, and it is escalating rapidly. We already have civilian casualties on both sides, and we have the real possibility that the United States also gets involved in this conflict, which has the potential to cause major disruptions to the global oil market, and so the global economy and stock markets. I'm going to show you exactly how we are approaching this market right now at Bravos Research, sharing you the details of our current trading strategy. Now, in essence, our strategy can be summarized like this. When conditions are favorable, we want to be trading aggressively and initiating trades on the strongest stocks in the S&P 500. These are stocks that have the potential to outperform the rest of the market by orders of magnitude. Think of being long on Apple or Netflix in the 2010s or being long on Tesla in 2020. But when conditions are unfavorable, we want to be very defensive. That means we're initiating much less trades, and if we do, we're looking for setups that are completely uncorrelated from the broader US stock market. And there is a reason why this trading strategy works so well. Take a look at this chart of Apple between January of 2008 and January of 2009. The stock dropped by 60% during that time period. And the same thing can be said about Amazon and Microsoft. These were three of the most promising technology companies of the early 2000s, and they were all in vicious downtrends due to unfavorable market conditions. But now fast forward to the period between January 2009 and January 2010, and you saw these stocks post absolutely incredible returns, outperforming the S&P 500 by 3 to 5 times. These were favorable market conditions where the strongest stocks in the S&P 500 posted absolutely record gains. Now, Apple, Amazon, and Microsoft are just famous examples of very large companies that outperform significantly. But there are countless of other stocks that also outperformed the S&P 500 during that time period. Our strategy revolves around spotting these very early and making sure that we're exposed to them when market conditions are favorable. Now, I'll show you some of these opportunities later in this video, but first we have to answer the question, are market conditions favorable today with major risks like tariffs, a global recession, and now the conflict in the Middle East? The truth is, taking into account and being able to predict exactly how each and every one of these risks is going to impact the market is close to impossible. Take the conflict in the Middle East, for example. You would expect this to guarantee that the stock market is going to decline. But history shows that major geopolitical conflicts really don't tend to impact the stock market all that much, with the stock market in the majority of cases actually being higher 1 month, 3 months, 6 months, and 12 months after major geopolitical events. So in order not to get caught up in all of the noise, we have a very systematic approach at Bravos Research to identify whether conditions are favorable for the stock market or not. And there's really 3 metrics that we look at to evaluate this. The first one, and one of the most important parts of our strategy, is volatility. We want volatility to be low, because in a high volatility environment, we're going to see the stop loss that we put on our trades get hit much more quickly than in a low volatility environment where the daily moves are much smaller. This is an index called the VIX. It measures the volatility of the S&P 500. And we can generally say that when the VIX is above 30, the average size of the S&P 500's daily move is going to be 5 times greater than when the VIX is below 20. So this is an environment where your trades are much more prone to getting stopped out. As you can see, volatility has been falling back down over the last couple of months, and the VIX index is now sitting below 20, which is a favorable environment to trade in from a volatility standpoint, as our trades are much less likely to get stopped out. The only worrying sign for us right now is that the volatility index of the S&P 500 has been trending steadily higher over the past year, which has made market conditions gradually less and less favorable. And now with a potential escalation of the conflict in the Middle East, it's possible we begin to see volatility pick up again. For now, however, volatility is objectively below our threshold of 20, which isn't telling us to stop initiating new trades. The second key metric that we watch is signs of risk-taking. If we're not seeing signs of risk-taking behavior from market participants, it's unlikely that we're going to see incredible returns on our trades. And there's many indicators that we watch to evaluate this. But one of the big ones is something called the gold to silver ratio. Now, some of you might be wondering what on earth this has to do with the stock market, but this is an extremely valuable tool that we've discussed many times on this channel before. Gold is considered to be a risk-off asset that investors flock to when they're seeking safety, whereas silver is considered to be much more volatile and risky, and investors flock to it when they're willing to take on a little bit more risk, because they are more confident in the market environment. So in other words, when gold is outperforming silver, it suggests the market is risk off, meaning that there is no risk taking happening. But when silver is outperforming gold, the market is risk on, meaning that there is risk-taking behavior happening. And believe it or not, this is the signal that the gold to silver ratio is giving us today. This is what the gold to silver ratio looks like going back to 2020. As you can see, at the beginning of the pandemic, the gold to silver ratio spiked as investors were fleeing to safety, a risk-off signal. But during the recovery from the pandemic, the gold to silver ratio fell precipitously. And we've seen something very similar happen with tariffs. The gold to silver ratio spiked at the very beginning of the tariff announcements, but has been falling back down violently over the last few weeks. In fact, more specifically, we've just seen the gold to silver ratio drop by 10% within 3 weeks. We've seen this type of a rapid drop in the gold to silver ratio 8 times going back to 2019. Now, the ratio has bounced a little bit since the conflict in the Middle East erupted, but it has so far been a very minor jump relative to this big risk-on signal from the gold to silver ratio that we've had since the month of May. And if we add the S&P 500, we see that every single one of these episodes was followed by additional upside in the short term on the S&P 500. Now, again, do not take this for a prediction. This is simply telling us that the gold to silver ratio is suggesting there is risk-taking behavior in the market right now, which often happens when the market is steadily trending higher. This is a signal that is also making us more confident in the trades that we're taking ourselves. Now, the third metric that we look at to assess whether the market environment is favorable is something called participation. We want to see a large percentage of stocks within the S&P 500 participating, or in other words, moving higher. This is a way of assessing how stable the market environment is. Think of it like the foundation of the market. If many stocks within the S&P 500 are participating and moving higher, that means we have a very broadly positive market environment, which is more likely to lead to a steady market environment. But the weaker the participation, the more unstable the market is, and the more vulnerable it is to declining. This chart, for example, shows us the percentage of stocks within the S&P 500 that are trading above their 200-day moving average. Or in other words, it's simply the proportion of S&P 500 stocks that are trending higher. Right now, we have roughly half of stocks within the S&P 500 that are trending higher. This is not particularly impressive, and it's a much lower level of participation to what we had, for example, in 2024 or in 2021. Now, while this is not ideal, it's also not the end of the world. You can take a look at August of 2020, for example, where roughly only 40% of stocks were trending higher, and yet that was a great time to be initiating trades on the US stock market. Despite major disruptions to government economic and trade policy, and now an escalating conflict in the Middle East, the big increase in participation only came in the months that followed. It's entirely possible that we see something like that happen today. So 2 out of the 3 metrics that we use to evaluate the market environment are green today. So what does this all mean? Well, it literally means that we have roughly 2/3 of our trades at Bravos Research allocated to US stocks today. We have some exposure to silver, we have some exposure to foreign stocks, and roughly 15% that is unallocated. It's possible we'll need to stop out many of these positions at a loss. One of the things that we're doing in order to hedge against this scenario is that we've begun to gradually increase our exposure to the energy sector by adding the stocks that we think can benefit the most from a true escalation of the conflict in the Middle East. The gains on these energy stocks would more than offset any losses that we have. The remaining 2/3 of our active trades on the website are composed of roughly 10 US stocks that we think are going to be leaders if conditions remain favorable. Spotify, IBM, EME, PWR, KLAC, a semiconductor stock, NTRA, just to name a few. Now, it's entirely possible that if the stock market makes a big pullback, we'll need to stop out many of these positions. But if the low volatility and high risk-taking environment continues, we think we're very well positioned to outperform the S&P 500 over the coming months. If you want to follow our entire trading strategy, make sure to click on the link in the description down below and go to our website, sign up to our service, and give it a try.